Hey, good morning, everyone. Marty Missouri here, the 23rd of March, 2022, with a super quick stock market update for you. If you didn't get a chance yet, just look at the morning note, actually yesterday's and today's, where I suggest that there's sufficient worry in the market to keep it somewhat buoyed. Now, maybe counterintuitive for folks. You'd think if there's a great deal of uncertainty that stocks should be falling. But as you know, we've written about for years, the contrary indicator that is sentiment tends to play out, maybe more often than not, meaning when folks are on balance pessimistic, and when they're really pessimistic, then often that's a signal of at least a short-term market bottom. And when they are overly optimistic, right, everybody's on the bull side of the boat, well, then a wave could hit and suddenly everybody rushes to the other side, all at once. So it can kind of work in both directions. And my assertion right here is that with, for example, the tragic situation between Russia and Ukraine is one that, if it were to suddenly be resolved, and I'm not predicting anything at this point, then I think we would see a sharp rally. And then we wake up to the reality that inflation is a thing and that the pressure is enormous on the Fed to get in front of it, so much so that they're implying that they'd allow for a sufficient amount of market pain and even economic pain to get ahead of it. It's going to be a very interesting year, to put it mildly. So in terms of what the technicals are suggesting, so you're looking at the daily chart, and the market is making a valiant effort to crash upward through these real technical barriers that we've drawn here. Here you have the 200-day moving average falling right on the 50% retracement coming back from the recent all-time high. You have a downward sloping 50-day moving average, and some people call this a death cross, right, where the 50-day crosses below the 200-day. And yesterday, came through and closed above that. And you can see today, this is today's candle, struggling with that, kind of bouncing off that 200-day moving average. And then when we look at our momentum indicators, still, I'm going to say relatively bullish. We are seeing the RSI roll over a bit right here, relative strength index. And, trees don't grow to the sky, so we're going to lose some momentum here. But again, on balance, on the daily chart, all by itself, I'd say it's still a pretty bullish near-term picture. However, when we zero in on the real short term and look for clues on, say, the hourly chart, then maybe not so much. In fact, we had, going into this morning, a pretty clear upward wedge pattern, which is bearish, against falling divergences or bearish divergences in our two momentum indicators. So that was a clue that probabilities suggested that, a downward spike is coming, and we had this gap. This is between yesterday's close and this morning's open right here. So we'll see how this plays out. But on the very, immediate term charts, they're not bullish. They are arguably bearish for the moment. But again, this is, really short-term stuff, and you can see coming into this rally, right? You can see you had something that's not really a wedge pattern. That would be a descending triangle, but it was against real bullish divergences in the momentum indicators. And this was showing up, as I showed you on the daily chart as well. Now, when we zoom out and we take a look at the weekly chart, which, as I suggested on Sunday, was beginning to look fairly bullish. So we have this pattern that I identified all the way back roughly 30 years, where when on the weekly chart, each bar is a week, breaks down below the 50-week moving average and then fails a test or two, that invariably the market has come all the way down and at a minimum tested the 200-week moving average. And as you can see, there's lots of daylight right between here and there. But look what we have. We have last week closed above the 50-week moving average, and this week bouncing off like a pogo stick, bouncing off of it. So if this were to hold up, then suddenly this pattern that's been pretty reliable over all these years fails, right? That's an eventuality. Nothing works every single time, right? This dotted lines is where I faded out the flag pattern that I thought was developing here. And because now we've broken through that. Now, so is there an analog? Is there a recent history analog? And what happened in that event? Well, coincidentally, the one that really looks similar happened at a time where we had a similar setup, meaning the Fed was tightening monetary policy. And that was in the fourth quarter of 2018. So I'm going to start there in March of 2018, and I'll take us to Christmas Day. Notice that we had a very clear bear flag pattern back there in the fourth quarter of 2018. And I snipped what we were just looking at, and I want to put these two together. So here's the current situation, right, on the weekly chart. Here is the top in 2018. Here's the flag pattern. Wow, it looks very, very similar, right, to what we have over here. Then we came down, and you can see the market trying to come back. And like this one, it came earlier than the price target would have been. And just barely closed above it. This would be, like last week's move. And then here we are, and at one point, this right here, folks, looked like this right here, right? Because again, we're still just Wednesday, so the week's only halfway through. The market did go up, wanted to extend that breakout, and by the end of the week, it had fallen back apart. And by the time we got down here to Christmas Day, we're looking at on an intraday basis, a 20% decline. On a closing basis, it was 19.8%, so it didn't qualify as a textbook bear market. We came out of it, and then the Fed turned dovish. This really got under their skin, and Jerome Powell went from being a hawk to a dove. The infamous Powell pivot, and the language coming out of the Fed and the actual actions coming out of the Fed flipped and became very accommodative again. Well, the key difference between here and there is that we weren't dealing with 40-year high inflation prints and the prospects for more to come. We were dealing with very benign inflation, and the signal was that to the Fed was that, hey, we can get easy here and we don't have much to worry about. Well, that's not the case today. So folks, suffice to say that this is a precarious setup, and we could see this morning's little sell-off get bought just like everything else, but at the end of the day, we think there's just going to be a lot of chop, a lot of noise, and we think that folks need to be aware of and compensate for the fact that there still is some serious downside risk in this market. Folks, thank you as always for watching and listening. Be back again soon. Take care. Bye-bye.